Today we're going to walk through the sale of a business. Not a hypothetical business, but an actual business that we've sold and the steps that it involves. And I can't get into all of the nitty-gritty for confidentiality reasons, of course. However, this should paint a fairly clear picture of what are the steps involved in selling a business, different milestones along the process, and how it's facilitated from start to finish. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market, M&A, capital advisory investment banking firm, helping companies generating typically between $1 million to $10 million in pre-tax profit or EBITDA to sell their businesses or secure capital. So in this particular scenario, again, we sell businesses kind of across all industries, but tend to be of that size, as we just mentioned. It also tends to be what we call non-sponsored situations. So most of the time, not companies that are majority owned by private equity, venture capital, or other such institutionalized capital. So a lot of times largely owned by entrepreneurs, families, small groups of investors. But nonetheless, for this particular scenario, we're going to talk through the sale of a specialized packaging company. So this is a company that made particular, think boxing, kitting, packaging that sold into a very specific industry for the transportation, kitting again, and distribution of certain goods. And so specialty packaging is kind of the broad industry in this case. Sizing of the business was it generated between $2 and $3 million a year in EBITDA, or pre-tax earnings. It had been in business for over 20 years. So fairly long history, established, fairly consistent from a profitability perspective, and therefore serves as a good case study because it's fairly kind of down the fairway or down the strike zone of business. Now, reason for sale, ownership was reaching mid to late 60s, no succession plan in order in the sense of having family or other people within the business that's going to transfer down to, and therefore seeking a sale to a third party. So we are engaged as the investment banker's representative of the company to facilitate this exercise. And the first step of this is crafting the narrative of the business. Now, prior to the engagement, there are several dialogues that take place. We're learning about the company, we're reviewing financials, reviewing other key information. However, when we begin an engagement, one of the first steps is we're sending a series of questions to the client. And this is a mixture of qualitative and quantitative considerations, but allows us to craft the narrative of the business. Now, let's be clear, what this is not is a root canal of information. We are not asking for all of the tax returns. We are not asking for the bank reconciliations. We are not asking for all of the monthly and weekly accounts receivable and payables aging for the last 25 years. What we're really trying to get to is what's necessary to craft the narrative of the business. Remember, the sale of a company is the right narrative to the right audience with the right process. So we are asking for the fundamentals of the business, that is largely the financials, certain other reports, understanding the people, the processes, the products. What are the stratifications of what they provide from a product perspective? What are their client base look like? What does their organizational chart look like? Crafting the narrative around what is in place such that it can be clearly communicated. In addition to why are they different? There's gigantic packaging companies. Why is this one able to perform profitably, consistently? What do they do that other people don't do? And so I won't get into the specific as we don't allow anyone to kind of back into who the company may be. But nonetheless, we're able to gather all of this information, and typically that takes 5 or so hours from the client side to get us that information. We're analyzing that, and we're boiling that down into 2 primary areas. We are putting some of that information into kind of our initial materials that we reach out to parties with on an anonymized basis. And secondly, we're pre-populating a data room, and therefore that is, think of a Google Drive, a Dropbox, things of that nature that will contain the rest of the information. Now, at the same time, this is typically within the first 3 weeks of an engagement, we're also doing a lot of heavy research relative to who some prospective acquirers would be, building an audience. Our business, and very different than others, is we're not in the business of just sending an opportunity to a 10,000 person mailing list and praying for the phone to ring. And that's traditionally how a lot of these deals in this size range have been undertaken. However, we don't believe, and we have seen from our experience, that it doesn't generate the optimal results. And so what we want to do is we are doing research as to who the optimal counterparties or acquirers may be. And we're looking at people where this could be the missing puzzle piece. Again, that's a concept we've discussed in other videos, and you'll see throughout this video of kind of the process. It's worth checking out some of our other videos because you can go take deeper dives into what some of these concepts mean. And so you're going to hear a lot of these buzzwords. I'd say check out our YouTube or LinkedIn archives, if you will, to get a little more color in it. But the idea of the missing puzzle piece is companies are generally valuable because of 3 prongs. They're fundamentals, and that is the revenue, the gross profit, the EBITDA of the business. The second being the access the company has to demographics, geographics, industries, who they serve. And three being the capabilities, that being anything proprietary that they do, the things that they have patents on, what is special about the business, what's their edge, what's their competitive, durable advantage. And in the case of the packaging company, one, they sold into a very specific niche, difficult to access, difficult to penetrate, large client base that takes a long time to get trust with, that takes a long time to get into the system with, if you will. And then secondly, they provided certain types of packaging that were very, very difficult to manufacture, that moved very, very specific products that were also, call it high value and somewhat volatile in ways. And so the combination of these unique capabilities as well as this unique audience made it such that this was a very interesting space for other acquirers because they were selling into a broad audience, but they could not penetrate this part of the market. They did not have a solution for this type of product. And their thesis, and what we kind of reverse engineer as we're reaching out to parties, is to say, listen, if you had these capabilities, you'd be able to sell all of this company's stuff to all of your other clients. Conversely, or complementary, let's say, if you had this end market access, you could then sell all of your things to this market. So the missing puzzle piece thesis really works twofold in that if you could say that this is a new audience access that you can sell your products to and a new offering, a capability that you could sell to your existing clients, that's where these things fit real snug. And so in our research, we find typically about 200 parties. Sometimes it's split evenly between financials and strategic. Sometimes it's a little more strategic, sometimes it's a little more financial. It depends on the facts and circumstances. But we look at 200 parties that we believe in some way have a need or a desire for the missing puzzle piece that our client represents. Now, not only are we finding the companies, because it's easy enough to say, oh, I think Microsoft would love this company, or in this case, I think Honeywell would love this business, but rather finding the specific context within each. And that's its own science as well, because there's certain roles within certain organizations, and we have a lot of ways through our own databases, through AI, through our own networks, that we are finding not only the optimal counterparties in terms of a need in the missing puzzle piece, but the optimal context within those that are A, the right person, and B, going to respond and engage in a dialogue, whether that's phone, email, text, or otherwise. And so, around the 3-week mark, we are now reaching out to these parties. Again, we are representing a company that does a thing in this particular industry. We're not getting into the specific in such a way that they can back into who the specific client is, but you have to give enough information. And so this is a two-way street. We are giving them enough information to get a sense as to whether we believe they're interested, and at the same time, we are evaluating them. We want to know their experience and aptitude. We want to know their track record, particularly in this industry or other closely related industries. We want to know their capabilities, their financial wherewithal. Again, we're going to be talking to private equity firms with billions of dollars ready to go, strategics that are billions of dollars, but then smaller situations too that could have a need that would fit really well. You really want to reach out to the full spectrum. And so we're turning over those rocks. And so day 21 to day 60 of this engagement, we're out there talking to people, engaging in dialogue, saying no to some people, having some people say no to us, saying yes to others, having others say, yes, we'd be very interested. But the idea is you separate that wheat from the chaff such that at the end of that particular time period of the process, when we hit that 60-day mark, we have reached out to in excess, because where you find a little bit of traction, you reach out to a few more, in excess of 200 parties. And in this instance, we had 50 signed non-disclosure agreements. So the idea is you have these dialogues anonymized. If we vet the person and believe that the firm, the strategic, the institution is a bona fide party here, we will have them sign an NDA. And at that point, we allow them into the data room that we had pre-populated, as mentioned, and added things to along the way. That now gives them further information. Now they learn the name of the company. And we have separated a lot of the wheat from the chaff without disclosing the name of the business. So we're at day 60. We're at effectively peak audience in the sense of we have all of the signed NDAs of the parties that we believe are the real interested parties. And now we start the process back down towards the offers. And so this is effectively the extraction or chiseling period, if you will. And so there's more dialogues. We have many steps in this exercise because the challenge can be that there's some parties that are in it for a real reason that they want to buy it, and there's other parties that can be in it just to try to gather information. Now we try to sift all of those out from that kind of 200 to 50 party synthesizing, if you will, but at the same time it still needs to be something that we're really, really leaning on, because again, we don't want to be in the business of turning no's into yes. We don't want to be the business of turning maybes into yes. We want to find all of the yeses and see who really wants to be the most in that direction, who wants to be the most aggressive, and who really wants the company, and that's where oftentimes you're able to get the best results. And so as we are working through that process, we're having follow-up dialogues, we're collecting information, we're collecting more questions, requests, and usually between that 60-day and 90-day mark, we do go back to our client with one more follow-up request list, if you will. And so there's a couple more hours involved in getting us a little bit more information. Again, we're very careful not to disclose the highly sensitive information. So at this point, we're still not giving away customer names. We're still not giving away employee names. And we are really trying to continually sift and sift and sift. And so in a situation like this, we are ultimately boiling down to, in this case, 15 preliminary offers for the business. As we're discussing those with the counterparties, that includes value of the business, that includes a structure of the offer, how much is that closing, what's over time, what are the contingencies. We've had many videos talking about these 4 elements. And then the third element being, what is the transition for ownership? In this case, ownership was desirous of retiring, moving out of the business in a fairly expedited manner. And fourth, what happens to the stakeholders? So again, value, structure, transition, stakeholders. Stakeholders being community, being employees, things of that nature. So we create a matrix of what these offers were. In this case, we had many offers. Again, we won't get into specific values, but let's just say EBITDA multiples for this particular business in the 5 to 8 times range. And again, kind of breaking down what the different structures were, but we create that matrix of these 15 offers and we bring it back to our client and we say, look, this is what we've been able to extract from the market in this 90-day period. Let's sit down and have a conversation about it. So we're going to pause there, and in the next video, we're going to dig into how this deal went from the point of getting the preliminary offers towards the closing of the deal. So this has been the exercise thus far. We'll dig into the second part of it in the next video. Hope the week's getting off to a good start for everyone. Keep pushing forward. God bless. We'll see everyone next time.